All right, but the first thing I want to do is I want to talk a little bit more about employee stock options. All right. When we say options here, by the way, we're not talking about things like calls and puts. Those are typically contracts between third parties in the marketplace, and it's usually those are transacted involving existing shares out in the market. That is, if I buy a call out in the marketplace and I exercise it, the company's not issuing a new share. Someone is providing me that share by virtue of that contract. All right, so I'm not talking about shares, I'm not talking about calls, I'm not talking about puts. When I talk about options, I'm talking about employee stock options. All right. How does an employee stock option work? Well, they represent the opportunity for me to acquire shares in the company's stock, usually over a passage of time. All right, so how they work, let's say I go to work for Microsoft. My first day at Microsoft, they say, okay, Jeff, we're really happy to have you. In addition to your base salary and your bonus, we're also going to issue you some stock options so that as you work hard over time, your hard work will hopefully translate into a higher stock price at Microsoft. If you can exercise these options, you'll get to share in that upside. All right, so it's the opportunity for me to get some ownership of the company and share an upside of the stock price. Okay, let's assume when I go to work for Microsoft, they give me 500 options. So in each one of those cases, or if I get 500 options, it gives me the right to buy 500 shares of Microsoft at a set price. Okay, and that set price is something that we call the strike or the exercise price. Let's say it's 10 bucks. All right, so when I choose to exercise these options, I can buy 500 shares of Microsoft stock at $10 a share. Basically means I need to pay them $5,000 and I'll get 500 shares. Make sense? All right. Well, the other piece of data we need is we need to know what is the current price of the stock. All right, remember we mentioned that concept of in the money versus out of the money. If I'm going to buy these at 10 bucks a share, hopefully the stock price is higher than that. All right, if it's not, let's say the stock price is at 6 right now, I'm paying $5,000 for something that's only worth $3,000. All right, in that case, the options would be out of the money. And I wouldn't exercise them. I would just hold on to them. It doesn't cost me anything to hold them. There's no cost until I decide to exercise. But if this share price goes to, say, 20, now I can buy something for $5,000 that's actually worth $10,000. And I make $5,000 in the process. I make a profit. In that case, this would be in the money. Does everybody see that? All right, so these would be quote unquote in the money. All right, but the other twist here is we haven't considered the notion of vesting yet. All right, when I go to work for Microsoft, they want me to work hard. All right, they also want me to work hard over a long period of time. All right, if the share price goes to 20 the next day, they don't want me to exercise all my options, take my profits, and leave. All right, because they haven't gotten really any benefit from my working there. So typically what companies will do is they will assign a vesting period, typically in years, typically about 5 years, such that at the end of each year that I've been employed by Microsoft, 100 of those 500 stock options would become mine, would become exercisable. All right, so at the end of year 1, stock price has gone to 20, I'm 1/5 vested, now I can buy 100 shares at 10 bucks a share, turn around and sell them for 20 bucks a share and make a $10 profit. Make sense? Concept of vesting? Okay. That's something that we're going to be able to capture in our valuation template in order to calculate our fully diluted shares outstanding. All right. We would contrast fully diluted shares outstanding with something called basic shares outstanding. What are basic shares? It's just the shares that are currently outstanding in the marketplace. If you take the front page of any 10K or 10Q, and when I say front page, I mean the page that looks like this. Usually at the bottom of this page, it will tell you how many shares were outstanding of the company's common stock. And in this case, in the case of Heinz, it's 314,439,706 shares outstanding. All right. When we calculate the effect of dilution, we need to add that to the basic share count and treat those dilutive securities as though they've already been exercised. The rest of the market does it. Research analysts do it when they're valuing the stock. Institutional investors factor in dilution when they're valuing the stock. We need to do it as well. If we're not doing it, if we're only using basic shares outstanding, our share count is too low, and when we multiply that by the stock price, it gives us a market value of equity that's too low. When we add that into our total enterprise value, it undercuts our overall valuation. Right? So the other thing I'll note before we move on here is warrants basically are going to be treated similarly. To the extent they're in the money, they're going to need to be exercised. Most public companies don't have really a lot of warrants attached to them. Some public companies, though, will have convertible preferred stock or convertible debt. Right? And the same type of analysis applies if it makes more economic sense to the holder to exercise those and treat them as common, then we will exercise them. All right? Typically what will happen is they might have convertible preferred of $1 billion at a conversion price of, say, $10. Right? Well, if the stock price is 20, what that means is the holder of that convertible preferred can convert that into common shares that are now worth $20 as opposed to 10. Right? So it's in the money. We would convert that preferred stock to common, and then we would also need to back out that preferred value from our enterprise value calculation before, so we don't double count it. Right? It can be either convertible preferred or convertible debt, or stock. And if they're converted, we need to make sure we are just treating them one way or another. We'll see that in an example as well. Okay, there are two different methods that can be used to calculate dilutive shares, that is, figuring out how many of these options would need to, or how many new shares would result from options exercise. You can use what's called a weighted average diluted shares method, or you can use something that's called the treasury stock method, which is really what gets done on Wall Street or in banking. Folks really focus on the treasury stock method. Basically what this method assumes, and put all this text aside for a moment, what this assumes is that when I exercise my options, again, I need to write a check. I need to pay for them. Right? I don't just get free shares. I'm just exercising my right to buy shares. I need to give Microsoft a check for $5,000. What the treasury stock method assumes is, rather than just issuing 500 new shares, what Microsoft is going to do, it's going to take that $5,000, go out into the public marketplace and buy as many shares as it can of its own stock for $5,000. Then whatever it can't buy of that 500 shares, it will issue as new stock. All right, so this treasury stock method assumes that something gets done with that cash and that the company is not just issuing 500 brand new shares. Does that make sense? In this case, if the share price is now, the current share price is 20, I exercise at 10, right? I give Microsoft $5,000. They go out into the marketplace, they can buy 250 shares with my $500 and issue to me 250 new shares. And only those new shares, only that 250 new share number would get added to my basic share count. And the way the place that we find this, the information we need, because we need all this information, we need to understand how these options work for each company. It's actually in the very back of each company's 10K. So if you take a look at Heinz, for example, and we go to the back of their 10K, and this is a pretty typical presentation of an options table. There are two basic columns, options outstanding and options exercisable. Who can tell me the difference? So the difference between these two columns, total outstanding, not vested, exercisable, are only those that have vested. Right. When we're doing a comparable public companies analysis, we are focusing only on those that are vested. All right, so we're going to be working over in this column on the right. Make sense? Now, in a precedent transactions approach, we're going to look at it a little differently. We'll get into that later. But for now, comparable companies, we're just looking at options exercisable. And now if we look over to the left, you see that you've got basically three groupings of options here. And they're grouped by the range of their exercise prices. So these get issued over time, probably issued each year at a different range of exercise prices. And each of these groupings represents options that are issued in different ranges of exercise prices. All right, so we have three different groupings: those that were issued between 29.18 and 35.38, those that were 35.39 to 44.77, and those that were basically 44.78 to $54. Right. Now, of those three groupings, here are the numbers that are exercisable within each. All right, again, these are in thousands, so this 7.326 is really 7.326 million. Right? So always be aware of where your decimals are, especially when you're entering into a model that has a different decimal convention than what's in the financials. So these are how many that are exercisable, basically vested within those groupings, and these are the weighted average exercise prices associated with each grouping. Basically, those are the items we need to capture for our model. And we're going to go through an example of that. I'm going to show you how this fits into our model. Then our model, once these data have been input, our model will use the treasury stock method and automatically calculate how many net new shares need to get issued. All right, but this is an options table. This is a pretty typical presentation of an options table. Okay, they can be presented in slightly different ways, but at the end of the day, they usually all contain the same information. They'll distinguish between total outstanding and total exercisable. They'll give you the ranges. They'll give you the number exercisable, and they'll give you the exercise prices per share. At a minimum, you'll have that information. Questions on that? Let's actually go, we're going to do an example of this. What I'm going to do, and if you want to follow along on this, I'm going to go through Heinz and basically spread some of the financial information for Heinz, and then go through my options table and capture all that relevant information and get to the point where I've got enterprise value for Heinz and I can calculate multiples for Heinz. Your homework then will be basically to replicate what I do for General Mills and Kellogg. If you want to follow the file you'll need to open is Valuation Model Shell, and that's in folder 2 of your course materials. So you're not going to have as many files as I have here. I've got some that I use for my own purposes. But Valuation Model Shell. All right, and when you open that up, what I want to do is, this is a valuation template. This is pretty standard. This is pretty similar to what you would find if you worked in an investment bank. Someone would have put together one of these templates. And so really your goal as an analyst is to go through and populate these templates. You don't have to recreate them from scratch. They're really detailed. It would take forever to create it from scratch. You're just going to be populating selective data. All right, everybody get that open? All right, before we go and start putting in information, again, I want to introduce everything that's in this valuation model. Along the bottom, you've got 6, 7, 8 tabs, all right, each representing a different pieces of data that we're going to need to enter, different worksheets that we're going to use along the way. All right, this template will include everything we need to do a comparable companies analysis, a precedent transactions analysis, and a DCF. So it's all getting done in one file. And at the end of the day, when we've done all those analyses, we're going to summarize our data on this far left tab that's called ValSum. Everybody see that? Now, the way that you navigate inside an Excel file that has multiple tabs, you can use your mouse and click on those tabs. But remember what I said yesterday about using the mouse. You want to start getting away from that and using keyboard shortcuts. Right? How do you edit? How do you navigate between these tabs only using a keyboard? Who knows the shortcut? No, Alt-Tab will actually switch between programs in Windows. That's a good one. To navigate between tabs, though, you're going to use Control Page Up or Control Page Down. Control Page Down takes you to the right. Control Page Up takes you to the left. All right. So that's how we navigate. So let's introduce these, and then we'll do a quick example of Heinz, and then we'll take a break. All right. So on the Val Sum tab, again, this is my valuation summary. This is where I'm going to summarize the results of all three of my valuation methodologies. All right. So for Company A, I've got a comparable public companies approach, and I'm going to summarize all my data here. Over on the far right, I've got an implied total enterprise value range. That's basically my conclusions. All right, my conclusions of value for each multiple that I use within comparable public companies. I've got the same thing for precedent transactions. All right, I'm going to value Company A based on a multiple of latest 12 months revenue, based on a multiple of latest 12 months EBITDA from precedent transactions. And then I'm going to run a discounted cash flow analysis. And at the end of the day, I'm going to have several different data points over in these right-hand columns that I will use to formulate a final opinion of value. And what we've done here is, if you look in column H, the title for that column is representative level. That is basically, these are the results of that hypothetical Company A for the last 12 months. So their latest 12 months revenue was $195 million. Next fiscal year, we expect them to do $205 million. And these are hard-coded. You see that they're in blue, so I manually input those numbers. And again, Company A is hypothetical, so these numbers are just made up. All right, I made them up, entered them in here. My latest 12 months EBITDA, next year's EBITDA, latest 12 months earnings, next year's earnings, etc. All right, from that, we're going to select some ranges of multiples, which we're going to base on the analyses we're about to perform. So we've got a lot of work to do. At the end of that exercise, we're going to get a bunch of multiples from Heinz, from Kraft, from Kellogg, from General Mills, from Conagra, all our comparable companies. We're going to select the appropriate ranges of multiples here, and then we're going to multiply that representative level by those multiples to give us valuation indications. Make sense? Okay, this is a tab, this is a worksheet that has been pretty nicely formatted. Right? This would be something we would probably put in front of a client. Usually it's going to be the first page in our valuation section of whatever we're sharing with a client. This is kind of like an executive summary of all the work we've done on valuation. Right. Next tab, if I control page down, one to the right, this is the summary. It's called Comp Sum. This is the summary of all the work I'm going to do in the comparable public companies analysis. All right, so this methodology has its own summary page, and as we scroll down, we see all of our comps listed on the left: Kraft, Conagra, Heinz, General Mills, Kellogg. And for each comp, we're going to capture some key pieces of data that are going to be useful in figuring out what the valuation of Company A ultimately will be. Most importantly is over to the right, we're capturing those all-important valuation multiples. All right, so what was what was Kraft trading at? What was Conagra trading at? Okay, your model should have some values for Heinz there. I've pulled certain numbers out of my model, so I can use that as an example. All right, so when I'm done with the example, our numbers will match. All right, but at the end of the day, these multiples are going to be the most important part of this exercise. That's what we're ultimately looking to capture. And then down below, we've got some comparative data. We're taking a look at each of our comps. What are their growth rates? Growth rates for revenue, EBITDA, earnings per share. How much were they spending CapEx relative to revenues each year? Right? Are they replenishing their fixed assets? And then real importantly, how profitable are they? How well are they running their businesses from a profitability standpoint? What were their margins? EBIT margin, EBITDA margin, net margin, etc. And we're going to use these data next week to make some comparisons between these companies, make some comparisons with our Company A, and ultimately use that analysis to figure out which multiples are going to be the best ones to apply. So this is all really useful data. Again, this is something you can see that this worksheet's been pretty nicely formatted. We'd put this in front of a client as well. All right, and importantly, there should be no hard codes on this tab. Everywhere you see link in your homework, that's an instruction for you to link to somewhere else in the valuation model and get that piece of data. All right. So where it says link, you need to create a link to some other data. If it says input, it means you need to hard code some input in there. All right. We've tried to. Yeah, and links will be in black, inputs will be in blue. You'll see that in a moment. All right. We're going to explore a lot more of that next week. We're going to talk specifically about why would, say, Kraft. If I look at a total enterprise value to revenue multiple, why does Kraft trade at 1.4 times while ConAgra trades at 0.85 times? Big difference. Right? This basically is saying that for every dollar of revenue Kraft generates, the market rewards them with $1.39 of enterprise value. Right? Whereas for every dollar of revenue that ConAgra generates, the market only rewards them with 85 cents. Big difference. All right? The market values each dollar of revenue very differently between those two companies. We'll explore that next week. We'll really dive into that and figure out why, because that's a key question to answer when we do valuation. Any other questions on this? Next tab, if we control page down once, it'll take us one to the right. This is our comp spread tab. This is where we spread our comps. This is where we enter all those pieces of data that I talked about before, their revenues, their EBIT, their EBITDA. This is where we do the treasury method. This is where we enter share prices. Okay, everything we need to calculate our multiples is going to be entered in here, and we've created a lot of different formulas to do a lot of the work for us. All right, this is kind of like this, and this is, by the way, not something you'd put in front of a client. This is a very big worksheet, a lot of numbers, a lot of data all over the place. All right, it would be messy to print out and put in front of a client, probably overload, something they wouldn't want to see. All right, this is where we're going to be doing our work. Kind of like if you ever took an exam and had scratch paper that you didn't turn in, then you turned in your exam. This would kind of be like your working papers. All right, so that's our comp spread tab. Next tab to the right, this is our precedent transactions tab.